welcome to Barita Money Talks. My name is JDL Owens, Senior Manager, Business Development, and your host for tonight's session. I'm pleased to have you join us. Now, the objective of this webinar is simple. We want to not only provide you with clarity, but we want to help you, our valued investors, turn insight into action. We'll provide you with practical strategies to empower you to navigate this environment market confidently. This is not the year for you to sit idle regarding your portfolio. It's the year for you to position smartly. And we're going to help you do exactly that. Our presenters will be touching on 4 key aspects tonight: the macroeconomic environment, budgeting strategies, Barita's top stock picks for 2026, and unit trust opportunities. So let me go ahead and introduce our speakers for tonight. First and foremost, the dynamic Ramon Small Ferguson, Chief Executive Officer, Barita Investments Limited, and Managing Director, Barita Unit Trust Management Company Limited. From the Barita Brain Trust, our research team, Shane Bennett, Senior Research Analyst, Kelsey Bourne, Investment Analyst, Carlton Stewart, Assistant Vice President, Retail Sales and Service and Retail Partnerships, and last but not least, Kerrion Newman, Senior Manager, Business Development. Now, before I hand over to our first presenter, just a few housekeeping matters. Feel free to drop your questions in the chat. We'll address the key ones towards the end. And yes, we'll be doing a giveaway, so keep your eyes and ears open. Without further ado, I'll hand over to Ramon Small Ferguson, who will provide us with a brief address. Ramon?
Well, thank you very much, JDL, and thank you very much to everyone for joining us today. We really appreciate your continued trust and partnership with Barita. I mean, without you as our clients, we really wouldn't have a reason to exist. I'm going to keep my remarks this evening very brief and focused on 2 main areas. The first is just to give you a brief perspective as it relates to the state of our business, and in particular, in light of the passage not so long ago of Hurricane Melissa and the effects on the market environment and businesses like ours. The second is that I think many of you would know by now that we have recently completed the acquisition of JN Fund Managers Limited. I'm going to tell you a little bit about how that is going. With respect to the state of the business, we would have recently released our Q1 results, and next Wednesday we'll be doing our usual investor briefing and diving deep into the outcomes and the reasons for those outcomes. But as a little bit of a preview, I just wanted to talk a bit about how the business is doing, again, in the wake of the passage of Hurricane Melissa. As you know, the hurricane disrupted the economic activity all over Jamaica last October. And like many financial institutions in the space here in Jamaica, we would not have been spared from the impact of the hurricane. Admittedly, investor confidence would have softened in the wake of the hurricane, and transaction volumes with respect to certain client transactions would have slowed. And of course, equity markets would have priced downwards. That environment is really what we would have seen for Q1 to December of 2025. Right? As a consequence, our own performance was hit, specifically related to the performance of our equity portfolio. That would have really impacted revenue that otherwise, if the performance of the portfolio was even flat, would have been up year over year. We do actually have some bright spots in our Q1 performance, as net interest income would have increased, and fee and commission income would have increased. Our balance sheet remains very strong. Our capital base actually grew, so even though earnings were down year over year, the fundamentals of the business are still very strong. I mean, our view is that our Q1 performance is really much more transitory than anything else, and it really reflects that temporary disruption that we saw in Q1 rather than anything structural. And we're really looking forward to future quarters where we anticipate that a rebound will start. And this company that you have chosen to partner with as your investment advisor on your journey is very strong. We're well capitalized. We have almost $36 billion in capital ratio. That's well over 2 times the required regulatory minimum. And we're rated A+ on the local scale from a credit perspective by Caracris. Over the past few years, we've really been very deliberate about investing in our governance, our risk management, analytics technology, our human capital. Some of it is on show here today. And these investments are precisely what allows us as a business to remain steady and disciplined, even during periods of volatility. I mean, you saw it during the pandemic. You saw it during the 2021-2023 period where rates were going up. And you have seen it now post the impact of the unfortunate tragedy of Hurricane Melissa. I mean, for us, resilience is not built in one quarter, right? It's built from deliberate investment over time. It's intentional, and that has been our process. Right? So I want to talk to you now a little bit about what's driving the future of our business, right? And our recent acquisition of JN Fund Managers Limited. That's really been one of the most visible and biggest strategic developments that our business has had over the last couple of years. And with this acquisition, it's really a deliberate attempt on our part to expand our institutional asset management platform. We really brought in now almost $80 billion in additional funds under management. For us, it also puts us squarely in the pension fund management space. Right? JN Fund Managers is a large pension fund manager, and it helps us to deepen our presence in the portfolio management space and our capabilities there. And will ultimately broaden the range of solutions that we have for you, our clients. It translates to greater scale, I'd say better ability to construct and manage your portfolios, and better risk oversight. Right? So for us, it's really another step, not only to grow the business, but to enhance our capability to serve you as our clients. So I want to close with this. Periods like the one that we're in, as JDL kind of intimated in her opening, where the background is uncertainty, actually represent potentially a set of opportunities. Right? And our hope today is that we're going to be able to start to uncover some of them for you. These are times when I always tell the team that we earn our money as advisors when the picture is not so clear. Right? So I'd encourage you all to pay attention, pay keen attention. As JDL said, we have some prizes and surprises at the end. And I hope that we're able to impart some knowledge to you. So thank you again for joining, and I'm looking forward to interacting with you throughout this process.
All right, thank you so much for that, Ramon. You said a lot. But I have a question for you. You would have highlighted our most recent acquisition of Jamaica National Fund Managers. How exactly had that transition been going, and how well does this align with Barita's strategy?
Great question. So the transition has been going pretty well. Right? We have made just a few moves in the early days. We would have installed a new interim CEO, Richardo Williams. And Richardo, if you have been paying attention to our investor briefings, would be no stranger to you. He's also Senior Vice President of Asset Management and Research here at Barita Investments. And Richardo started in January and has hit the ground running. I mean, the first phase of this process has really been just us getting to know the lay of the land, engaging with the clients of the company. Really it's about stability, getting to know the team, and really looking at how we can learn from the entity that would have been acquired. At the same time, see what elements of our business can complement what they're doing there. So our expectation in terms of the future, as I mentioned, is that this will really give us better capacity to serve our customers, better scale. Really, it will give us a broader range of products, and we're looking forward to bringing that to the Barita crew. And on that side, in terms of the customers there, we're looking forward to bringing the Barita flavor there too.
All right, thank you so much again, Ramon. Okay, now on to our next presenter. To ground us where we are going locally, and globally. I'll invite Shane to walk us through the macroeconomic environment, but just so you know, let me tell you a few of Shane's credentials. He is a CFA charter holder. He holds his master's in economics and his bachelor's in economics and statistics. Shane, over to you.
All right, thank you, JDL, for that very warm welcome. And before I head into the local outlook, I would like to just, spend a few minutes discussing the global macroeconomic context, right? So, at a very high level, right, we see where the global economy is now moderating towards its long-term growth trend, with the IMF projecting that global growth of around 3% for 2026. We do note, however, that risks are tilted to the downside, and this is more so a reflection of ongoing trade tensions between major trading partners. Now, moving from the global context to US macro, we do note that there is growing uncertainty around the policy posture coming from the Trump administration. And in an election year, this is setting up 2026 to be very interesting. Now, uncertainty will likely remain a core theme that will drive returns in capital markets in the US. Moving beyond just the growth picture in the US, we do also note that the inflation picture is something worth mentioning, with CPI, well, more so the PCE, which is the Federal Reserve's preferred measure of inflation, still running well above its 2% target. And consensus really around that the Federal Reserve will continue to reduce rates, or modestly reduce rates, through to the end of the year, right? Now, with that being said, I would just like to quickly switch focus to the local macroeconomic outlook, really just providing some more context and really building on what was mentioned by our CEO, Ramon Small Ferguson, right? So, we would have seen that for the third quarter of 2025, Jamaica would have actually reported very strong growth. And this is a reflection of recovery following Hurricane Beryl the year before. Now, these economic gains would have been very short-lived following the passage of Hurricane Melissa in the fourth quarter, right? And with the passage of Hurricane Melissa, the economic outlook for Jamaica over the short term has deteriorated significantly, with economic contraction forecasted of about 4% for the current fiscal year, which ends March 31st, 2026, right? Before a very modest rebound for the upcoming fiscal year. Now, just to spend a little bit more time on Jamaica's fiscal position and the deterioration in our fiscal position, we do want to also highlight that Jamaica's debt to GDP is expected to increase to just above 68%, with Jamaica's fiscal deficit widening. Now, when I say fiscal deficit, that means that the government will now be spending more than what it would have collected in tax revenues, right? And going beyond that, the anticipation is that recovery will take around 3 to 5 years to get back to pre-Melissa levels of economic activity or output. Now, moving on from just the growth picture to spending some time on the inflation picture and monetary policy dynamics, as well as considerations for Jamaica's external position, we do note that as the inflation print for January 2026 was actually much better than what have been anticipated, with the CPI index actually falling almost a percentage point month over month for January. And this would have brought the headline inflation figure down to 3.9%, which is just below the BOJ's 4 to 6, the lower band of the BOJ's 4 to 6% target range, right? And this would have prompted the BOJ to actually reduce rates at its most recent Monetary Policy Committee meeting, which was held last week, right? And this would have followed the better than expected outturn and an improving inflation outlook, right? So with that in mind, the expectation is that we could potentially see the BOJ coming at subsequent meetings and actually reducing rates further to support economic growth over the short to medium term. Now, moving beyond just the inflation and the monetary picture, we also want to take a look at Jamaica's external position. Now, the expectation is that Jamaica's trade deficit will widen, which will be a reflection of lower exports and higher imports as we navigate this post-Melissa environment. But with that in mind, we also do want to note that Jamaica's net international reserves remains healthy at around 6.7 billion US dollars, which translates to roughly just over 52 weeks of goods import coverage. And this really means that the BOJ is projected to actually be able to maintain its strong presence in the FX market to support the Jamaican dollar during this uncertain time. Right? Now, with all of that being said, I would just like to link it back to our local equity market and the expectations around it. Now, the local equity market, we do anticipate it to remain weak over the short term as a result of lower profitability and waning investor sentiment that could lead to an extension of the bear market that we would have observed in 2025. Now, the impact of Hurricane Melissa is expected to be uneven, not only just across sectors, but also across companies, with recovery also likely not to be uniform, right? With some sectors likely recovering faster than others. Now, with that in mind, our prescription to clients is that they pursue selective exposures to companies with strong balance sheets, durable earnings, and a history of dividend payments, right? Which is really just to support portfolio stability while also providing dividend income. So with that in mind, we suggest that clients remain nimble to benefit from potential opportunities that may arise over the short term. With that, I would like to hand back over to JDL.
All right, thank you so much for that, Shane. That is quite a sharp perspective. Now, I have a question for you. You would have mentioned essentially a 3 to 5 year recovery period considering Hurricane Melissa. What exactly does this mean for my stock portfolio?
Okay, that's a really good question, JDL, and it's something that we all need to be mindful of. Now, I would have talked about the short-term outlook for Jamaica, considering the passage of Hurricane Melissa and the strong likelihood of a fairly strong, deep recessionary environment. Now, with that in mind, we also do note that recovery is anticipated for FY 2026-2027, with even stronger recovery expected for the following fiscal year. Now, bearing that in mind, it does create an opportunity for investors to now come in and dollar cost average down on certain investments and position themselves for the eventual recovery. So the prescription to clients is that they come in, talk to one of the investors, well, not the investors, but one of the advisors, of course, right, to really just take a look at your portfolio and see how we could potentially improve some of those holdings to better benefit from the eventual recovery.
All right, thanks again for that, Shane. Now, we move into what I believe most of you are interested in, how to exactly position your portfolio. The research team has essentially identified 4 stocks that we believe deserve your attention in this market cycle. I'll hand over to Kelsey, who will take us through this part of the presentation, but before I do, I want to also outline her credentials. Kelsey is a CFA Level 1 candidate. She holds her bachelor's in economics and banking and finance, and she also has a master's in corporate finance. Kelsey, over to you.
Thank you so much, Jadel, for that introduction. So today my job is to run you through our stock picks for FY 2026. Now, on the heels of Shane's economic outlook, we want to look into stocks that will do one thing: create a defensive positioning in your portfolio. So the economic moat for all of the stocks that we'll present here today would be their ability to have relative insulation against economic headwinds. Now, these stocks are going to come from a variety of sectors, including manufacturing and distribution, food and beverage, finance, and industrials. Now, how do we really classify a stock as defensive? Now, they need to have three key criteria. So this would be their ability to have resilient revenue generation, consistent dividend payout capacity, and also strong business models. So let us go straight into our stock picks. So the first stock pick today will be Caribbean Cement Company Limited. Now, CCC has been on our radar since before Hurricane Melissa because of our expectations for increasing capital expenditures for infrastructure development. Now, of course, those priorities will shift towards post-Hurricane Melissa recovery efforts and reconstruction, but we do expect that demand to remain the same. Now, this will bode well for Caribbean Cement with the expectation for demand in cement and construction products to be on the rise. Now, we expect that Caribbean Cement will help to benefit from this and also have resilient revenue generation coming forward and also consistent dividend payouts. Now, secondly, our next stock pick would be Seprod Limited. Now, Seprod is one of the leaders in the food and beverage sector. Seprod, we do expect to have benefits from its unique positioning from geographic diversification of revenue streams following its 2022 acquisition of a majority stake in A.S. Bryden & Sons, which is a Trinidad-based manufacturing and distributing firm. Also, the company is going to benefit from what we call demand inelasticity from its exposure in consumer essentials and non-discretionary products, especially in this post-Melissa economic environment. Our third stock pick will be Scotia Group Jamaica Limited. Now, this company is one of the leading financial institutions in the sector, and in an environment where we do expect an increase in loan delinquencies or defaults, we do see where Scotia's strong credit risk framework is going to come as a benefit to the company and investors. Scotia also does boast a low non-performing loan ratio, and also looking at it against its counterparts, we expect it to have a relatively low level of expected credit losses. So again, this is going to help the company to maintain its ability to have consistent dividend payout capacity. Last but not least, we have Trans-Jamaica Highway Limited. Now, Trans-Jamaica Highway has been a breakout star in the Jamaica Stock Exchange due to its ability to maintain capital appreciation and also dividend paying capacity for investors throughout the years. Now, our economic moat, in Trans-Jamaica is rooted in our expectation that we do not expect a sharp downturn in traffic volume. Now, why is that? Because we believe that our friends in Central Jamaica are going to continue to demand these toll routes so that they can continue to commute into Kingston for work obligations. Once again, this is going to help to maintain revenue resilience and also dividend paying capacity for this company. So to end the presentation, there's one thing that I want you to remember, this word, being defensive. Now, being defensive in your portfolio positioning is incredibly important in periods of economic downturns, just to ensure that you maintain getting returns on an ongoing basis when capital appreciation is not necessarily something that you can look forward to on a consistent basis within the market. So with that, Jadale, I will hand over the reins to you.
All right. Thank you so much for that, Kelsey. Now, I have a quick question for you. You would have outlined Trans-Jamaica Highway as your fourth pick, right? Are there any clauses in Trans-Jamaica's concession that could materially cap their returns?
So thank you so much for that question, JDL, and it is incredibly important to look at the concession agreement when assessing a stock like Trans-Jamaica Highway. Now, the concession agreement is set to expire in 2036, which is about 10 years from now. And in that time period, we do expect that there is a possibility that the government and Central Jamaica could renegotiate the terms that are currently in the agreement. However, based on the information that we have available, we do not see it as a near-term risk for investors.
All right, thank you so much for that, Kelsey. All right, so now that we have an understanding of the environment, I suppose the next question is, how do we financially navigate it? So that takes us to our next presenter. Carlton Stewart will tell us how to exactly budget.
All right, good evening, everybody, and thanks for joining. So all the persons who are online with us, thank you so very much. So JDL started by saying just now, where do you find the money from? You heard from Shane and Kelsey earlier about the macro environment and the stocks that we are currently recommending. So we're saying purchase stocks in Trans Jamaica, we're saying purchase stocks in Scotia Group, purchase stock in Carib Cement, Separate, etc. Then the question may be, Carlton, where am I going to find the money from? And that's where I come in today to tell you what we want to do. So guess what? For 2026, I want to budget better because we have to live smarter. And as I continue, I want you to know that your financial health, it is your responsibility. So I don't want us to take the notion that it is in the hands of somebody else. How it is that we start our investment journey is left up to you. So some people may be asking, is now a good time to start investing? And the answer is yes. It is always a good time to start investing, but you need to be consistent as well with investing. But where is the money coming from? Reality check. So inflation has been eating away quietly at our spending, at our purchasing power, right? That's the first thing. Secondly, lifestyle adjustments sometimes impacts our spending because of how we desire sometimes to live. Many households currently, they are earning enough money, but they are not saving as much. And it is so important that we zone in on not so much how much we're earning, but how much is that we're keeping back, how much is it that we're saving and investing, because that is so important. So if you leave with nothing else today, I want you to leave with knowing that let me start focusing on how much I'm actually saving and investing now. So I need to be budgeting better, because from the income that you're earning now, guess what? You need to start doing things a little bit better so you can start investing. But why aren't persons budgeting as how they should? Number one, persons are using an emotional approach to budgeting. So you'll get your salary this month, and luckily yesterday was payday for some persons who are monthly paid, and you'll say to yourself, oh, I'm monthly, yeah, man, I'm gonna treat myself. And immediately you get paid, before you do a budget, you run to buy some fast food, you run to buy a nice Chinese lunch, you run to buy a nice something without taking a nice step back to do an actual budget. That is an emotional approach to budgeting, and I want for this year for you to change that. Before you spend $1 out of your salary, sit down, take up your pen, your paper, take up your laptop, and I want you to record and do your actual budget. One of the other reasons why persons fail at budgeting, they don't track what they're spending. You just spend as though you have unlimited income, and that cannot work for this year. We're changing that for this year. Number three, sometimes they ignore irregular spending and sometimes the small spending because it's so small, sometimes you ignore it. And those are the ones that sometimes adds up over time. When you do a budget, it's not a one-off thing. I want you to go back and to review the budget to see if you are in line. So you say that I'm going to be spending $100,000 on groceries, for example, before the month ends, you're at 120, 130. Where will that extra money come from? You need to review the budget. And lastly, what is your money mindset? That is so important. Because for many persons, why we're not investing or why we're under investing or why we're not being consistent is our money mindset. And that is really our unique belief towards our attitude with money. That is so important. So I'll give you an example. So if someone grew up maybe in the lack, not having enough money, in poverty, for example, when you're much older, you can take two approaches, you know. The first approach can be because you grew up in poverty, you're saying, boy, I have some money right now, I'm not going to spend it because I don't want to go back in poverty. So you hoard the money, you don't save, you put it under the mattress, and that is not going to work this year. Or you have the persons on the opposite end who says to themselves, I grew up in poverty, so guess what? Any money I get now, I'm going to enjoy it. YOLO, I'm living once. And when we go to both extremes, it doesn't benefit your investment journey. So we want to change that mindset. Yes? I'm going to ask some questions now for persons who are online, and I want you to answer the questions. Don't put it in the chat because you don't want the person to see your business. What you have to do is answer mentally. If any of these connect with you, it's time to reach out to one of our advisors. Yeah? So the first thing, are you depleting your savings monthly? So for example, you decide to save $20,000 per month, and by the 10th of the month, you draw out $5,000 out of it. By the middle of the month, you draw another 5. Before you know it, the 22nd of the month, you draw out another 3. So really and truly, you put away 20,000, but you withdrew maybe 18. If you are doing that, contact one of our advisors so we can get you in shape. If the collectors are calling you, if you're not paying your bills on time, for example, you took out something at one of the furniture companies and they are calling you to come back for the fridge and the bed and the stove, that's happening, call one of our advisors. You need some advice. If you are depleting your long-term savings, that's a challenge. For example, your retirement fund. If you're going into your long-term savings to fund your current lifestyle, that's a challenge and we need to fix things up for you. If you are not investing, if you have not started to invest as yet, if you are only saving, you need to call one of our advisors because that is a red flag financially, and we're getting rid of those red flags this year. And if you only have one stream of income, that is something that we need to discuss as well, because we need to start doing things a little bit differently this year so we can start, leveling up financially. So let's jump into budgeting. What is budgeting? It is really a written record of your income versus your expenses. Simply put, it is you planning how your money should be spent. It is you telling your money where to go. And the challenge is many persons allow the money to tell you what to do, and it doesn't work like that. Because if you write down your budget, whether on your laptop, whether on an app, whether in your diary, you will know when you do your budget what I can and I can't afford. And that's a challenge that we're finding with many persons. When you allow the money to lead you, you realize that there's nothing left sometimes at the end of a given month to start investing or to start saving. And guess what? We're not doing that this year. We're doing things differently. So why should you budget? Number one, it's the first step to financial success. You never find a successful company who doesn't budget. It's not going to be there. So if a company wants to be successful, they do a budget, right? And they follow that. If you intend to be successful on your financial journey, you have to start there. So listen up. I need to control your day-to-day expenses, and that is so important. One of the major things, your day-to-day expenses, you need to track those. And I'll give you a real-life example. I work in New Kingston, and I remember a period, maybe about 3 or 4 years ago, I get to work early, and I say to myself, I discovered Canon Cafe Blue somewhere here, or that Canon ball right here, and I would go there and get their omelette. Like every morning, I'm buying an omelette. And I say to myself, Carlton, you deserve the omelette. You work hard, Carlton, you deserve the omelette. They have this nice bagel with the cream cheese, and I'll just buy that. And I realized at 1,007 or 1,008 for one of these sandwiches or the omelette, that month and I'm doing my checks, guys. And when I checked my credit card statement, I'm like, hold up. That was over maybe like $30,000 I'm spending just arbitrarily because I'm telling myself, Carlton, you deserve this omelette. And guess what? Many of you are watching today, you do the similar thing. You say, boy, I deserve this new shoes. I deserve this new cologne. I deserve this new outfit. And chances are you don't need it. Yeah? And stuff like that, you will do, which will erode your investing capability. And I want to pull back a little. I said to myself at that point in time, that 33 thereabout that I spent loosely that month, just buying fast food, buying omelets, buying this, I said to myself, I'm going to commit to investing that $30-something thousand every single month for a year. And that was my introduction a few years ago to say, let me be consistent and believe it, yes or no, that paid off a few months from now. So you don't need to start very big with investing, but you need to be very consistent. All right, for the budget now, let's look at the 5 buckets that must be in your budget. The first thing, these are your essentials. Obviously, when you get paid, the mortgage needs to be paid, the rent needs to be paid, the light, etc. These things should not catch you by surprise. You shouldn't be caught off guard with your mortgage, for example, or your rent. It is due every month. So don't miss any of those things. The next bucket is for wealth building. You need to be investing. So there must be a category for investing in your budget. There must be one for protection, for example, for your insurances. There must be one for your lifestyle. Because guess what? You're working hard, you must enjoy your money as well. And giving is a part of your budget. So ensure that you have those 5 categories. Let me give you a pictorial of what it should look like. So your needs should take up 50% of your income. If you're earning $100,000, for example, or $200,000 as the example, $100,000 for your needs. For example, for the rent, for if you have car payments, for food, etc. The other 30% towards your wants, and 20% of your income should at minimum goes towards your investing. I want to take a step back. Calculate your salary now. Take out the pay slip. Go mentally. I get 100,000, so this month I must be investing, for example, in our unit trust, 20,000 Jamaican dollars at its bare minimum if you intend to build wealth. And I want to take a look at that. Take a picture of that right now, capture screen it, and then we can talk further on that. When you do your budget, and this is why many persons shy away from doing their budget, guess why? When you do the budget and you say, why, Carlton, the expenses are more than the income, you know. So that's the reason why I can't. So I'm just do the bare minimum, and that is not going to work this year. So if the income is more than the expenses, that's ideally where you want to be. Yeah, you have more income to cover the expenses. But the average person will tell you, Carlton, my expenses are more than my income. That's just the harsh reality. And I mentioned earlier in the start that your purchasing power is going down. It's because things are going up, prices are going up, and your income is not going up at the same rate. And that's just the harsh reality. So when it is that you realize you do the budget and you have more bills, more expenses than you have an income, 2 options. First option, possibly cutting the expense. Ask yourself, what can I cut from my expenses? Yeah. So maybe you stop buying salmon and you start buying just some fish fillet. Yeah. Maybe you stop buying oxtail. You start buying some turkey neck. Yeah. Maybe you stop buying lamb. You know, you start buying some pork chops. Right. You start doing some of those things that kind of cut back a little. You start buying your jasmine rice. You go say your regular rice because you're trying to cut down on some of the expenses. But the harsh reality, there are some things that you just can't cut. You can't cut some things. You cannot cut the fact that you need to go back to work. You cannot cut the fact that you need to pay the light bill and you have no control over JPS sometimes. Even when you iron once per week, the light bill is just coming at you. What do you then do? Focus on increasing your income. The reality is you cannot go to your boss every month when things go up and say, boss, yeah, I want a salary increase, you know. That just doesn't work either. So what do you then do? I want you to look at how can I monetize my talents? How can I turn the gifts that I have into an income generating opportunity for myself? And sometimes you say, I don't have the time, Carlton, things, I have this to do and I have that to do and stop it. Those are excuses. If your expenses are more than your income and you cannot cut them any further, it is time to either look a new job, and that's just the harsh reality. Or if you can't get a raise of pay, you start doing something else on the side until this translates into income. I'll share another example, another personal story. I remember when I was in banking, commercial banking, a few years ago, and I'm doing my thing. You're getting your salary, you're getting paid, whatever, you're doing your thing. And I went to purchase a lunch at, I share the story so often. I went to purchase a lunch at Burger King, and if you are in New Kingston, you know this gentleman that sells socks in New Kingston. And he said, boss, you don't want the socks. I'm like, all right, I don't really want the socks, but I'll support. At $100, I bought the socks. I bought 5 of the socks, and I went back with my burger in my hand. Went to the lunchroom, and the men in the bank are like, Carlton, socks, where get the socks them from? Instantly, I said to myself, you don't want socks? Socks no one? I'm selling socks. Guess what happened? Those socks I bought a while ago for $100, I said to my brethren them in the bank, I'm selling socks. Per one is $500. Nice and easy. So instantly that $500 I spent earlier, you know, turned to 2,500 Jamaican dollars. Instantly I put down my lunch, run back out to Northside Boulevard to buy 10 more socks because I'm now in the socks business. You may be saying, but I'm just giving an example. That was my opportunity to start a second income. When I realized that was not working, if you check my car trunk 5 or 6 years ago, I'm selling socks, I'm selling ties, I'm selling typing, I'm selling ladies' shoes, everything. That may work for Carlton. I want to think about what you are doing and what you can do very, very well. How can I turn that into more income? Because guess what? I have to start buying stocks in Transjam. You have to start buying stocks in Scotia Group. You need to start buying some stocks in Carib Cement. But you need the money to start. You cannot cut the expense after you do the budget. So you have to raise the income. And if you learn nothing else today from my presentation, you want to assess your skills, your talents. How can I turn that into a business? So the big question is, do you want to end this year financially like we ended last year? If you ended last year broke and you're on the call, you cannot do that this year. We're not working with that this year. Yeah? Those broke days we're not going into this year with that. So we want to change the mindset. We want to change the approach. We want to change our strategy in going forward this year, and it starts with how you earn 1, how you budget 2, and how you spend 3. If you need help, guess what? We have a banking arm as well with some very experienced bankers who can help you to maybe put your debts together and do give you a debt consult so you can have more disposable income to start your investment journey. If you're in the market and you're looking, for example, motor vehicles, we have the banking arm that can help you with that at the bank. If you're looking for your mortgage, we have that as well. We can do that quite well. So I want you to think about that. If you're looking to do some fixed deposits as well from the banking side, that starts as low as 50,000 Jamaican dollars. And that is something that you can do to ensure that your financial life it not pop down. So this year I want to focus on that, and let me know if you need any assistance, any help. You can DM in one of our licensed financial advisors to kind of walk you through, to guide you, because this year we're doing much better with our financial lives. My name is Carlton. It was a pleasure spending the last maybe 10 minutes with you. And if you need any help, you know where to find me. Wonderful.
All right, Carlton, what can I say? You deserve an omelette.
I deserve it.
I'm going to buy you an omelette. Thank you so much.
Thank you.
I do have a question for you,
Sure.
just for the benefit of our viewers, because this is a question that I get asked a lot. Would you say it is better to save your emergency fund in your savings account, or would you rather invest it?
And I'll answer in a couple of seconds. I want everybody to know what is the emergency fund. So everybody who's on the live right now, you need to have at least 3 to 6 months of your total expenses saved in an account, just in case there is an emergency. So you start with 3 months for right now, then you kick off your investment journey. So where do you save your emergency fund? You save it in a high yield account. So Carlton, what is that really? You don't want to save it at your bank, for example, that is paying you 0.1% per annum. So you want something that is giving you return a little bit higher than inflation. So Shane mentioned the inflation figure earlier, about 3.9 I think. So once you're getting return higher than that, so put that in, for example, a unit trust. And at Barita here we have quite a number of those options, which you'll hear a bit later. But my recommendation, JDL, is to put your emergency fund or saving in a unit trust on the investment side. Yeah, that's what you need to do.
All right. Thank you so much, Carlton, for dropping those gems.
No problem.
We'll now move on to a very important part of the presentation. For investors who prefer diversification or professionally managed funds, Carrie-Ann will take us through unit trust solutions.
Good evening, everyone. Thank you so much, JDL. As was mentioned, I have the pleasure of taking you through the final presentation of tonight. Earlier, Shane and Kelsey would have given you a bit of an overview of the macroeconomic environment. And then Carlton so beautifully went into how you can stretch the dollar a little bit more. But for those of us who may still be a little bit confused, I do have an investment option here that will give you a little bit more clarity in terms of being able to design your wealth building strategy. And that is our unit trust products. So the question is, what is a unit trust? A unit trust is a pooled investment fund where investors combine their money, which is then professionally managed and invested across a diversified portfolio. Some of the key things that you want to note with a unit trust is that you purchase units of the fund, and funds are managed by experienced investment professionals or fund managers. And assets include investments into stocks or bonds, or as I have here, equities or fixed income assets. Now, as written here, a unit trust is not simply an investment product. It is a structured, regulated, and professionally managed pathway to achieving your financial objectives with discipline and diversification. Now, why invest in a unit trust? We've explained what a unit trust is. The question is, why should you opt for a unit trust? And the first answer to that question is the professional management that you're able to receive. Now, all of us on the live here are busy people, right? We're professionals, we're business owners, and looking at the market or navigating the market is not your number one priority, but it is our number one priority, right? So with a unit trust, investment decisions are made by experienced portfolio managers or fund managers. And these are the persons who are able to conduct research, they're able to analyze trends, and they're able to adjust allocations as necessary. What this does, it removes the burden of investing from you. You know, with investing, sometimes the decisions can be, end up being emotional, they can be speculatory, and they can sometimes be impulsive, which can do some damage to your portfolio. But with a unit trust, because it's professionally managed, you're not navigating that market cycle alone. Secondly, a unit trust gives you the benefit of having structured risk management and regulatory oversight. Now, unit trusts operate within defined investment guidelines, or professional fund managers have to operate within clear investment guidelines, and the funds do have independent custodial arrangements. Another feature of the unit trust is that there's transparent pricing. So you're able to determine, or you're able to see how it is that we determine the net asset value or the NAV of the fund. Now, this structure provides accountability, it provides transparency, and ultimately you as the investor is protected. Now, the third reason why opt for a unit trust is the accessibility and liquidity that a unit trust gives. Now, with investment, sometimes a lot of the assets that you may consider usually have some high minimum amounts. And with unit trust, they break that down for you. So you don't have to have this large capital outlay to get into some of, or get exposure to some of the assets within a unit trust. Also, one of the really important benefits, I would say, with unit trust is the liquidity that you're able to get. With unit trust, the units of the fund are redeemable, which means that you, subject to fund terms, of course, you're able to have easy access to your funds. Now, the liquidity thus allows clients to align investments to their real-life financial goals. Another benefit that I would want to pause and mention here is that at Barita, we have the capability to give you a loan against your investment. So Carlton mentioned how, you want to create that investment portfolio and you want to be disciplined. You want to be adding, however often you make the decision to, but you want to be disciplined around your approach. So you've made a plan, but the truth is, we know that life happens. Things don't always go the way we plan, and so we may need some money from our investments. What a margin loan allows you to do is to use your unit trust portfolio as the collateral for a loan, and you're able to borrow and get cash in your hand. So we give you a loan with rates as low as 8.75, a maximum of 5 years to repay, and the loan is also up to 80% of your investment portfolio. So that sounds like a win-win to me. You're able to have your investment working for you while still having access to some cash. And finally, one of the most important reasons why you want to opt for a unit trust is the diversification that you're able to get. With a unit trust, you're not invested into any one stock or any one bond. A unit trust spreads your investment across multiple securities, multiple industries, various assets. And this is important because it reduces the concentration risk. Earlier Shane spoke about the fact that in a post-Hurricane Melissa environment, the impact to the varying industries won't be uniformed. And with a unit trust, what it is that you may have a particular security that, may not necessarily do well, but another one is able to offset that volatility that can ensue. So you're not relying on any single stock or any single bond to drive the performance. Now, it's important to note that diversification does not mean zero risk. It simply means that you're managing the risk intelligently. Now, We've looked at the core reasons on why you want to opt for a unit trust. So we just want to quickly look at the unit trust offerings that we have here at Barita. So we have our capital growth fund that's invested into local equities, as well as our FX growth fund that's invested into US dollar global equities. And both these funds are geared towards capital appreciation. We also have our FX bond fund, which is invested into global US dollar fixed income assets. And I'd like to pause here to mention that our FX bond and our FX growth fund were the #1 performing funds within their category across financial institutions in Jamaica. So that's a big deal, right? We have our real estate fund, which is invested into real estate linked assets. We have our money market and our income portfolios, which are invested into Jamaican dollar fixed income securities. And we have our FX accumulator fund, which is invested into shorter term US dollar fixed income securities. Now, we spoke about the core benefits, we've spoken about the options that we have, but it's important to look at what are some best practices to employ when you're thinking of investing into unit trusts. And one of them that I have to mention is the power of adding over time. A lot of times as investors, we think that we have to have a whole lot of money to invest. But the truth is, what if I were to tell you that sometimes incremental investing or adding in small amounts can sometimes be more powerful than one large investment? The reason for this, it does encourage disciplined saving, but it also reduces market timing risk, right? It also allows for price averaging. You're able to get in at various prices, and it also enhances compound growth. So monthly contributions can be more powerful over time than waiting to accumulate one large investment. You don't have to start big. What's most important is that you start consistently. A second best practice that I have to remind you of is that you should consider a portfolio approach. One goal, one strategy, one fund is not always the best option, right? You don't have to think that you have to cherry pick any one of our investment funds or cherry pick any one of our unit trusts. You need to look at a more combined approach, right? So you want to invest into multiple unit trusts that will give you an exposure to multiple asset classes. And what this does is make your portfolio a lot more resilient, and the portfolio is able to respond better to market cycles that will ensue within the portfolio. So a unit trust ensures diversification within an asset class. However, holding a portfolio of unit trusts ensures diversification across asset classes. Now, I couldn't leave here without giving some practical examples of how unit trust diversification and incremental investing can help to build a resilient portfolio. So, example 1. Mary is 30 years old and began investing at the end of December 2017 with $150,000 and contributed $25,000 monthly over 8 years. As a balanced investor with a 5-year goal of purchasing a property, she sought long-term growth while remaining conscious of volatility. Given her longer time horizon, her portfolio was growth-oriented, with 70% allocated towards growth assets and 30% towards income, which provides some balance and liquidity. Now, my graph here is able to show you how, based on her allocation, Mary was able to generate a portfolio with returns of over 33%. And this is between 2017 to 2025, using just the weighted average returns, right? To the bottom of my graph, you're able to see, had Mary opted to just save her money in a bank account, at the end of 2025, her returns would have only been 1.06%, right? So definitely, and making monthly contributions, having a portfolio that is diversified across assets has definitely benefited Mary throughout a time of uncertainty and unpredictability. Now, example 2, we'll use the same unit trust products, but a completely different scenario. So John is 50 years old and began investing in December 2017, again with $150,000, and contributed $25,000 monthly for 8 years. Recognizing that his pension alone may not sustain his desired retirement lifestyle, he focused on strengthening his financial position while managing risk. With a shorter time horizon and greater emphasis on capital preservation, his portfolio was more conservatively structured, with 60% towards income and 40% towards growth. Now, based on the performance of John's portfolio, though differently allocated, John was able to return over 32.18% to his portfolio. Again, when compared to where he would have averaged out if he were to just save the funds in his bank account, you can definitely see that he would have definitely been worse off. Now, for those of us on the live who you've heard all of this information and you want to take a renewed approach to your investments, we want to remind you of how you can add to your unit trust and how you can access the information that's necessary for you to make the decisions. So you can opt to make lump sum investments, but even better, you can set up monthly contributions. You can do standing orders or you can do salary deductions. All of that information is on our website, but you can give us a call at our customer care lines or call your advisor to decide or, to get the information on how to get that started. With a unit trust, you can opt to reinvest your gains. You can opt to reallocate your portfolio as your goals may change, as your goals evolve. In terms of information, you can access information from our fact sheets. Our fact sheets are updated monthly on our website, and it gives you an outlook in terms of, the assets within the fund, what our outlook looks like, and how you can better benefit from the performance of the fund. And then finally, use your Barita online to access your portfolio information. You can access your portfolio real time, be able to see the unit prices and so forth real time, and you can get all of that information online. We want adding to your unit trust to be straightforward because we have designed it to support disciplined wealth building. And some key takeaways you want to remember. Your unit trust offers diversification. It offers professional management. It takes away the work from you. You are protected through the regulatory structure of a unit trust. You get liquidity, you get flexibility, and of course, there are incremental growth opportunities. I want to close by saying that a unit trust is not simply an investment product. It is a disciplined, structured pathway to building and preserving your wealth over time. Over to you, JDL.
All right. Thank you so much, Kerry. I love the practical examples that you would have provided us as well. All right, so I do have a question for you as well.
Sure.
All right, let's say I have experienced a loss within my portfolio for about a year now. What exactly do I do? Do I go ahead and liquidate my portfolio?
So thank you for that question, JDL. It's one that we get quite often, especially when markets are, on the downside, right? But as an investor, I would first have to recommend that you look back at the initial reason why you started investing. What was your initial plan? What were your timelines? Has that changed? Has it changed? Then we may need to look at reallocating your portfolio. We need to look at, has your risk tolerance changed? Are you a little bit older now, right? Are you still earning the same amounts? Are you able to still add to your investments in the same way you initially planned to? So that's what we first need to reassess. It doesn't mean that you liquidate, get scared and run away, right? It may mean that we need to reallocate the portfolio. We may need to look and say, are you overexposed in a certain asset class? And do you need to spread the risk a little bit more? Do you need to get exposure to more assets? Were you heavily weighted in equities? Does it mean we need to balance the portfolio with more fixed income generating products? It doesn't mean that you close and leave investing and say, boy, this never worked out, forget it. You need to look at how can you best reallocate to have that portfolio performing for you.
Well said. Thank you so much. All right. So, ladies and gentlemen, viewers, we are almost at the end of our session. We're now going to continue the fun with question and answers or question and answer section. All right. Our first question for tonight is, can I invest on the New York Stock Exchange through Barita?
So I'll take that one, JDL. So at this time, we don't allow you to purchase, stocks directly on US stock markets. However, you can get the exposure through our FX growth fund. So I would have mentioned, the unit trust gives you that professional management. The FX growth fund gives you that type of exposure, and you're able to benefit from the returns that we're able to generate.
All right, thank you so much for that. Our next question. I don't have a portfolio yet. Shane mentioned a potential recession happening now. Is it a good time for me to start investing, or should I wait until the recovery period to get better returns? Shane?
Okay, thanks JDL for that question, and it's a really good question that we need to, outline for our clients or potential clients, as the person would have left that question in the comments. Now with Jamaica, with our outlook for the local equity market and the anticipation of a continuation of the bearish trend that we would have seen in 2025, it is now the case that a lot of stocks will now be on sale, trading at discounted multiples. And with that in mind, it is also the case that it's a great time for you to now get in, because time in the market is more important than timing the market. Now, with all of that being said, I would suggest for our potential clients to come in, sit down, have a discussion with advisors to see how best you can position yourself to benefit from the expected recovery that we would have talked about.
All right, thank you so much for that, Shane. All right, we have another question here. How would SEPROD be impacted by new taxes?
All right, so I will be taking that question. So in general, the special consumption taxes that would have been announced by our Minister of Finance will across the board impact all manufacturing and distributing companies that currently produce or distribute non-alcoholic sugary drinks, alcoholic beverages, and also produce or distribute cigarettes. Now, in the case of SEPROD, yes, they will face some implications from these tax measures. But one of the reasons why we have SEPROD as a defensive stock pick is because it has a full range of alternative product offerings within its product suite, and also with its acquisition of the majority of A.S. Bryden and Sons Limited, it also helps to again offer some domestic demand, just insulation in terms of product offerings and sugary drinks that would have been produced in the Trinidad market. So once again, looking at the defensive position of SEPROD, it will be impacted by the tax measures, but the company does have, as we demonstrated before, the ability to have insulation from this on a greater level than other manufacturing firms.
All right, thank you, Kelsey. Next question is, which one should I prioritize? Saving, clearing loans, or investing? What is the correct order?
All right, let me take that one. So if you do not have an emergency fund, the recommendation is that you start doing that first. So you need to ensure that you have that, or you start building that. All right, once you start building your emergency fund, you can possibly head over on the investment side, fully investing. However, depending on the debts that you have. So if these are high interest debts, for example, credit card debts, I need to tackle those. Because what you find is that you have high mounting credit card debts at maybe 30%, 38%. But from an investment side, you are averaging possibly 8% at its best. You are literally losing, basically. So I recommend formulating, getting your emergency fund in place. If you have high interest debts, you get rid of those first, and then you jump into investing. If you have other debts that are low, relatively low, or the purpose of the loan that you have is generating income, you can also head over on into investing. But remember, from what Kerry mentioned, you can start using the unit trusts to save your emergency fund. So you're getting a taste of the investment from even building up that fund as well. So that is my recommendation.
All right, thank you so much for that, Carlton. Okay, next question. Should my pension contributions through work be included in that 20%? I suppose that's the 20% that you would have
Mentioned.
acknowledged. Yeah.
Oh, for sure. So it is recommended that this 20% covers all your saving and investment towards wealth building. If you can afford more, definitely, but it's generally a part of the 20% I mentioned earlier. So
Okay.
yes.
All right. Thank you so much. All right. Can unit trust be opened for someone else, such as a family member, a minor, child, someone below the age of 18?
So I'll take that one, JDL. Yes, a unit trust can be open for someone below the age of 18. So you will need to provide the TRN of the minor. You will also need to provide a government issued ID such as a passport, and you will also need to provide the birth certificate. So you can definitely open a unit trust. You know, you may have your daughter, you have your son, and you want to be able to have something in place for them that you're contributing to monthly. So yes, that is a possibility.
All right. Thank you very much. Let's see. Is there a minimum to start the capital growth fund?
Yes, there is a minimum to start the capital growth fund, and that is 15,000 Jamaican dollars.
All right. And what about the FX growth fund?
So the
That
FX
question
growth
there.
fund currently is at 150 US dollars.
All right. Perfect. I think that wraps up our question and answer section. And we'll now go directly into our giveaway section. So we have 3 Barita box certificates that are valued at 15,000 Jamaican dollars, but they also come with a little sweetener. You'll also have the opportunity to set a planning session with one of our licensed investment advisors. So I'm going to go ahead and ask you a few questions, and the simple rule is whosoever is able to answer quickest in the chat will be the selected winner. All right, so are you guys ready? First question. Which 2 of our unit trust funds were the top performing funds amongst financial institutions? Which 2 of our unit trust funds were top performing funds amongst financial institutions? So that's for 2025. And these are questions that we would have gathered based on the presentations tonight. All right, we're seeing some responses here. Some are getting close. All right, I am seeing at Bree, is this Dre Bell for Life? I believe Dre Bell for Life would have answered correctly. It's both the FX Growth and FX Bond Fund. All right, now on to our second question. When executing your budget, what percentage of your income needs to be invested or saved? So when executing your budget, What percentage of your income needs to be invested or saved? All right, I think this is at Himix. I hope I'm getting that right. Himix would have answered the question correctly. It's 20%. So 20% of your income is required to be saved or invested. And our final question for tonight, what is the current rate of inflation? What is the current rate of inflation? All right, at O'Neill Doe 2364 would have answered correctly. That's 3.9%. Thank you so much to our viewers. And congratulations to our winners for tonight. I'm going to ask that the winners go ahead and email us their information at makingmoney@barita.com. That's makingmoney@barita.com. Now, ladies and gentlemen, we are now at the end of our session. I want to go ahead and thank you to all our presenters for their valuable insights, more than valuable insights. I'd like to leave you with 3 key takeaways. Markets will move, so it's important to remain disciplined. That's number 1. Number 2, your strategy must match your risk tolerance and your time horizon. And number 3, wealth building is intentional, not accidental. All right, so if anything has resonated with you tonight, I would ask that you speak to your licensed advisor, book a meeting, book a scheduled meeting, and start creating your budget today. Let's start a plan. I'm going to go ahead and thank you all on behalf of the entire team for spending the afternoon with us. Well, it's now night, spending the night with us. We appreciate your trust first and foremost, and we look forward to helping you create wealth in 2026. Thanks.